The Reserve Bank of India has announced its most aggressive monetary policy action in the past 5 years, aimed at reviving economic momentum and countering mounting global uncertainties. In a bold and decisive move, the central bank has slashed the key repo rate by 50 basis points, bringing it down from 6% to 5.5%. This marks the steepest cut since 2020, reflecting the Reserve Bank's growing concern over the recent slowdown in domestic economic activity and global trade disruptions. Additionally, the Reserve Bank has reduced the cash reserve ratio by a substantial 100 basis points, from 4% to 3%. The cash reserve ratio is the portion of total deposits that commercial banks must hold as reserves with the central bank. Lowering this requirement is expected to inject significant liquidity into the banking system, providing banks with more room to lend and support businesses and consumers. This twin easing, cutting both the repo rate and the cash reserve ratio, is seen as a comprehensive effort to not only bring down borrowing costs, but also to ensure ample liquidity in the financial system. The move comes at a time when the Indian economy is grappling with slowing consumption, declining private investment, and external pressures arising from rising geopolitical tensions and global trade instability. Economists and market analysts have largely welcomed the decision, noting that it reflects the Reserve Bank's proactive stance in addressing emerging risks and supporting economic recovery. The reduction in interest rates is expected to lead to lower lending rates across banks, which should in turn encourage spending, investment, and overall economic activity. The Reserve Bank also emphasized that it will continue to closely monitor both domestic and global developments and remains ready to act further if required. This policy shift signals a clear intent to stimulate growth and maintain financial stability in the face of growing headwinds.